Some of the hottest topics in economics currently are CBDC, that is central bank digital currency, and stablecoins. Now, in many cases they get confused with cryptocurrencies, and even though they have to some extent similar foundations, it is something completely different with different goals, different implementations, and so on. So in this lecture we will look into these topics, we will look beyond the hype and see what is actually going on. Alright, let's go. Let us start by looking into CBDC, central bank digital currencies. Now before we get started, you have to understand that this is something completely different to public blockchains, to open cryptocurrencies like Bitcoin, like Ether. It's often a little confusing because it's mentioned in the same articles, and many people don't actually understand that there is a huge difference, but essentially it's something completely different that happens to have some, well, no, that's not even always the case, but in some cases similar foundations. Now, what is a CBDC? Before we can answer that question, we have to look into central banks first and their role in the economy. And as you already know, central banks actually play a really important role in the economy. What they are doing is they're issuing the fiat money of a country, they're issuing the legal tender, so the money that is usually used in trade within the state, and they're doing so in various forms. Number one, of course, in cash. You're all used to that, you know that, with coins and bills. But number two is they also have ledgers. They also have these digital databases. When in most countries, you as a member of the general public don't actually have access to these central bank ledgers. What they're doing is they are providing these ledgers to various financial institutions, financial intermediaries, so banks have access to it. They can settle their transactions on it. They can have credit from the central bank, of course, which acts as a lender of last resort, but the general public does not have direct access to these ledgers. And this is a really important implication when you think about it. Even though you can hold legal tender, so the actual money of a state, in a physical form, you cannot do so directly in a digital form. All you can do is go to a commercial bank, have a bank account there, and then what you get is basically a promise for delivery for the legal tender. That is, of course, subject to counterparty risk. If your commercial bank, something happens to them, if they cannot pay it out anymore, if they cannot fulfill their promise anymore, then you might be at severe risk. Now, of course, there are things like a deposit insurance, but still you have a significant counterparty risk when you're using these commercial bank deposits. An additional counterparty risk, an additional risk that is even on top of risks that might already be there with fiat currencies. Anyways, all right, so this may change. I mean, the entire idea of CBDC, at least of retail CBDC, is that central banks can make their ledgers, so there's their central bank ledgers open to the general public, so that everyone essentially can have a digital currency issued by the central bank and hold it directly. That's the general idea. And there are a few factors that, I mean, it's a relatively old idea, but there are a few factors that contributed towards the seriousness of that proposal and the research that is conducted in that direction and the various pilots that are actually built all around the world. And number one is the severe drop in use of physical cash. I mean, it's not the same for every country, but when you look around the world, there are at least several countries, and Sweden is usually mentioned as a predominant example, where cash doesn't play a really important role anymore, where most of the transactions are in a digital form, be it through credit card payments, be it through money transfer from account to account, any privately created payment system. So there are various alternatives, but cash usually doesn't have that much and doesn't play that great of a role anymore. And then, of course, as I mentioned, this goes alongside this emergence of new payment solutions from the private sector. So there is some pressure, not just from the banking industry, but also from fintechs who are creating these new payment solutions that are heavily used in some countries. One popular example, we already briefly talked about that in the payment system lecture, is M-Pesa, for example, in Kenya. that essentially started as a service for mobile minutes, for cell phone minutes, and now is used as basically a payment system where people are storing these minutes, where they are transferring these minutes and are paying stuff with it. So it became from something entirely different. It actually became a payment system, which is quite interesting. And this, of course, puts some pressure on the existing infrastructure, also on central banks, because it would be somewhat problematic when they have no say in the payment systems of the future from their point of view, especially in terms of monetary policy, in terms of how they can control some of these systems. It might be really a challenge when there are all of these players from the private sector, but not the central banks themselves anymore, that are involved in these payment systems. And then, of course, this also goes with an ongoing debate on the mandate of the central banks, which of course includes money issuance, but then there's always the question of whether they should also be engaged in the infrastructure provision, and to what extent. And this is just a debate, especially in research and academia, but also in politics, that is currently going on. So these are the most important factors. These are the main drivers of this debate that led to various proposals, various pilots all around the world for these CBDCs. Now, when we look at CBDCs, what is it actually? And we have to go back to our cube of the monetary control structures. And there are many different definitions, but essentially CBDC just stands for central bank digital currency, and it has no further restrictions or limitations in terms of the technology. I mean, most of these proposals, they don't even use blockchain technology in a more strict sense. They might call it that way, but it hardly resembles any of the properties we have talked about so far. So what they all have in common, of course, is that they are created monopolistically, so by a central bank, at least for the pure CBDC, and also, of course, they are virtual. So we're not talking about physical CBDC. We're not talking about physical money, rather. Of course, when we're talking about central bank digital currency, then we're talking about virtual ones. Okay, but then everything right here on this line would actually be referred to as a CBDC. And now you can make the argument that some forms of these CBDCs, the restricted ones, so not the retail ones, but the wholesale ones that only have access to certain institutions, where only certain institutions that have access to it, rather, already exist. And that is true. I mean, you could essentially make the argument that some of these central bank ledgers, some of these settlement infrastructure are some form of a CBDC. They are traditionally not referred to as a CBDC because they lack any of these programming interfaces. They are built on these legacy infrastructure, but essentially it's pretty close to what people want to achieve. And what you have is you could have a heavily centralized CBDC in terms of transaction processing, but you could also go all the way up to a completely decentralized transaction processing that would, at least in this dimension, resemble cryptocurrencies. Now, I can tell you right now, none of the proposals are actually right here. They are all of these CBDC proposals go more in the direction of decentralized transaction processing, and as such are closely related to completely centralized databases and do not necessarily employ blockchain technology, at least not the one we're talking here, and at least not the one that you could reasonably assume to be immutable. Now, as I mentioned, there are various dimensions you have to consider, because there is no such thing as just a single CBDC proposal. There are various design patterns, various architectures. Number one is you have to ask yourself, is the CBDC centralized versus decentralized? I already mentioned that in terms of transaction processing, pretty much all of the examples are completely centralized. Then you have to ask yourself, is it retail or wholesale? Wholesale means it's a pure settlement coin where only a few institutions have access to it. So essentially a similar system to what we have right now. And retail would mean that the general public has access to it, so that you essentially have these assets, these fiat tokens that can be freely held and freely transferred by anyone. Not just the companies, not just the financial intermediaries. And then, of course, some technical questions. Is it token object based versus account based? So a token based model essentially is the idea that you're tracking this specific token. So you could also talk about the UTXO model, for example, and account-based from a technological point of view would be closer to what we see in the Ethereum system, where you're tracking individual accounts. Now you have to be really careful. That was the technical definition. Usually when economists talk about it, talk about the account system and the token or object-based system, then with the account system they're just talking about regular accounts like bank accounts, and with the token or object system they are talking about something that is closer to what we're seeing with Bitcoin or Ethereum. So they don't necessarily make the distinction between UTXO and account-based models from a technological point of view, but they rather say an account-based model uses the existing infrastructure, uses the existing bank accounts, and the token object-based is rather something new that builds on blockchain technology. Now, regarding the status, there is of course a lot of research. There has been since the 1990s. Bitcoin actually fostered the innovation in this space and put many central banks under pressure in the sense that they had to act. I remember in the early days of Bitcoin, when central banks first heard about it, then they have been interested, but of course still really skeptical. By the way, many of them still are skeptical, but it changed slightly. At least these days they can see that there are some innovative concepts in there, and in the last few years there has been an ongoing debate within most central banks. They have dedicated teams that actually are looking into it, that are trying to use this technology for their own benefit, for their own projects. And one thing that fostered it even further, the ongoing debate, and that really put many projects, CBDC projects, at the forefront of the attention, was Libra or Diem. So when Facebook first announced that they were going for this global stablecoin, then many central banks got really nervous and picked up significant speed for their CBDC projects. We have various pilots all around the world since approximately 2014. For example, the Dinero Electronico in various countries, then the e-krona project in Sweden, Project Jasper in Canada, the digital yuan in China. So really there are countless examples, and if you want to see a recent list, if you want to see what's currently going on, there is this great info page. It's cbdctracker.org, where you can find various projects and the information that is publicly known on these projects. Now, of course, as always, when there are some ideas around, you have proponents and critics. You have some pros and cons of these projects, and on the pro side, of course, with CBDC, you would have an enhanced transmission of monetary policy. For example, also negative interest rates could be directly conducted through these CBDCs, whereas with cash that's usually not possible. Now, depending on where you are on the political spectrum, this may be a pro or a con, but certainly from the point of view of central banks, this is a pro. They have more influence, more direct influence on these currencies, and therefore can transmit the monetary policy more easily. Then the mitigation of incentivization issues in the banking sector. So when they increase their influence on the actual currency, when they can issue it more directly, then you might be able to mitigate some of the misaligned incentives that we're currently experiencing in the banking sector and some of the issues that are thereby generated. And then, of course, the potential counteracting money laundering, or more broadly speaking, illicit activity. So when you have this one ledger where all of the transactions have to go through, when in an extreme case you don't have any physical money anymore, you wouldn't have any cash anymore, then of course it would be much harder in theory to conduct money laundering or any other form of illegal activities. Now, that being said, of course, when we go to the critics side right here, when you do that, then you might have some huge issues with privacy, and you might have some huge issues when, for example, somebody with malicious intent raises to power. I mean, when you have a potential dictator, let's say, and this person is in control of the entire payment system, and there is no way around it, you have to use it, you have to go through this one database, then this might be a huge issue. And even under regular circumstances, so not just in a dictatorship, but when you're engaging in trade, there may be good reasons why you don't want just someone to see every single transaction you're conducting, even if you have nothing to hide. It's just for privacy reasons. I mean, there's no good reason why there should be someone able to watch every single step of you. And again, this might severely impact your freedom, because under some circumstances you might not be able to speak up anymore when somebody could just watch every single step you take and potentially also freeze all of your funds. So that may be a severe issue and is a huge concern of some of the critics. And then of course there might be the undesired structural disintermediation of banks. So it's a question if there still is a role for commercial banks, what they are doing when people can go directly to the central bank. And last but not least, the unknown effects on financial stability, which actually plays along the last point. So when people have the option to withdraw their funds from commercial banks more easily and go to a system where there is less counterparty risk, this may actually, and that's a hypothesis by some economists, materialize in a digital version or virtual version of bank runs, where people just withdraw all of their funds from the commercial banks when they're getting nervous. And of course, when they can do that really quickly, when they can do that in a really fast way, then this may be problematic. But again, if we have to sum up really quick, CBDC, they are interesting. I think they are coming. They are something completely different to cryptocurrencies, have nothing to do with this entire innovation in the public domain with open public blockchains. It's something completely different. But still, I think it's something that is coming and something that is just a logical step for fiat currencies. Now, the other thing you usually hear about are stablecoins. And again, it's in many cases mixed up, CBDC and stablecoins, but it is something completely different. A stablecoin essentially is a privately issued crypto asset that is pegged to another asset. So it tries to maintain a stable exchange rate towards another asset. And this other asset usually is a fiat currency. So it could be the US dollar or the Swiss franc or the euro. And the idea of these crypto assets, of these stablecoins, is that they want to decrease price volatility, so maintain a relatively stable purchasing power over time and create a blockchain-based medium of exchange. So you've seen the immense volatility for some of these crypto assets. The idea of the stablecoin is that you can get around this volatility and create something that has a more stable purchasing power by pegging it to something that already exists and has proven, at least in the short run, to be relatively stable. There are various design patterns for stablecoins, actually 3 of them. Number 1 is off-chain collateralized. It's a really simple model. An off-chain collateralized stablecoin, you just have a central issuer. You have somebody who promises the delivery of the asset which your stablecoin is pegged to. So for example, when you're saying, I want my stablecoin to be pegged to the Swiss franc, then somebody could promise the delivery of a Swiss franc. Okay, and what they have to do to collateralize it off-chain is they actually have to have these Swiss francs on a bank account somewhere stored safely. And when somebody comes and presents the token and says, okay, please give me my Swiss francs, then they can deliver. That's the basic idea. There are several examples for the US dollar, for example, USDT, TUSD, USDC, and of course the risks for these off-chain collateralized stablecoins are counterparty risk. You have to trust the issuer. When the issuer runs with the money, when they are not keeping their promise, then you have a problem. So it's not decentralized, obviously. It's in fact heavily centralized. And you have some regulatory risks. Many of these stablecoins are or have been under regulatory scrutiny. They in many cases require banking licenses or similar licenses in order to being able to do so, in order to being able to be the custodian to hold on to these assets, and therefore you have a certain regulatory risk. Number 2 are on-chain collateralized stablecoins. The 2 most prominent examples are DAI and SUSD from here Synthetics, and this is the MakerDAO project. The idea is that you're locking up some of your crypto assets usually in a smart contract. It's locked there on the blockchain, and then you can issue some newly minted stablecoins. And of course, your position must be over collateralized because you have some fluctuations in the exchange ratio between the crypto asset and the stablecoin you're actually issuing. So you have to maintain an over collateralized position. And let's assume your crypto asset drops down in value, so you have a price decrease. Then you could end up in a situation where you essentially have a blockchain-based version of a margin call, where you either have to really quickly refund your position, add additional funds so that your position is again over collateralized to a certain threshold value. Otherwise, you will be liquidated automatically. Okay, so it is your position, the stablecoins you're issuing, they are backed by a different asset, by a crypto asset. Of course, the drawbacks, the risks are: number one, the liquidation risk. When your position goes underwater, when it's not worth enough anymore to maintain the over collateralization ratio, the minimum collateralization ratio, then you will be liquidated. Number two is the smart contract risk. There could always be an issue that the smart contract itself isn't programmed properly, that there are some issues in there, that there are some economic attack vectors within the protocol, within the smart contract system. And last but not least, in many cases, there are some external dependencies through oracles. Oracles essentially are just price feeds. When you think about it, in order for this liquidation to happen, you need some information on the current price of the crypto asset, compared to the USD or the Swiss francs, or the asset you're trying to peg it to, the stablecoin. And this is provided externally, usually from a somewhat centralized source. And it's called an oracle. And then last but not least, the algorithmic stablecoins, and that's a really easy one, because algorithmic stablecoins, what they're claiming to do is they don't want to have any collateral whatsoever, but still being able to maintain a peg to another asset. And economically speaking, that's just completely flawed, doesn't make any sense, and will not work in the mid to long run. When you think about it, when you're saying, okay, we have this asset, let's say the Swiss franc, and want to create something new that is pegged 1-to-1 to the Swiss franc, but we're not collateralizing it in any way, this will break down at some point. It might run quite well for a certain period of time, under certain circumstances, but it will get tested at some point, and then you're running into the various issues. Now, there are some implementations. I said there are no examples right here. Of course, there are some examples, but most of them actually broke down. And then there is this entire branch of rebasement stable coins, and stable coins in air quote because they aren't really stable. The idea of these rebase tokens is that essentially you have a fixed price, but what you're doing is you're adjusting the quantity. So let's say your tokens, they drop. You have this stable coin and it drops in value. It should be worth $1, but then it drops down to, let's say, 90 cents. Okay, so what you're doing is then you're just decreasing the supply, you're decreasing the quantity in everyone's wallet until every one of these tokens is again worth $1, because you have a fixed market cap, and then this market cap is divided by the number of tokens, of course, and then you can just basically adjust the quantity instead of the price. What does this mean for the user? As a user, I mean, you don't really care if what you want is you want a stable purchasing power, right, at the end of the day. And then it's hard to make the argument that this would be fine when you have a stable price for your stable coin, so it's always worth $1, but then in your wallet suddenly some of these stable coins disappear. I mean, at the end of the day, you would still have less purchasing power, so it would be hard to make the argument that this really is a stable coin when some of your tokens could just disappear, or another day you could have additional tokens in your wallet. You still would be subject to this volatility. It's not price volatility this time, it's quantity volatility, but essentially it's the exact same thing, and it's just an accounting trick. So again, personally, I'm convinced that these things are not going to work. I think off-chain collateralized is really interesting, even though heavily centralized, but that's where all the volume is currently. On-chain collateralized is super interesting. It has the potential to be completely decentralized and is something new. The biggest problem usually are the oracles right here, because you need some price information, need some price feeds, and this is some sort of centralization, of course, because this comes from outside the blockchain. It's an exogenous information, not an endogenous one, but still super interesting projects. Yeah, that's it from the central bank digital currencies and stablecoins. It was just a really quick introduction. We will talk about that in greater detail in the smart contracts course that hopefully will be uploaded next semester. But in the meantime, one thing you can look into is this paper right here, The Case for Central Bank Electronic Money and the Non-Case for Central Bank Cryptocurrencies by Alexander Berenson and myself, where we essentially make the argument that for the projects the central banks currently want to achieve, they don't really need a blockchain. When it's completely centralized, as it is the case with many of these projects, then it's not a blockchain. They should still do it. It's great that they're going to provide digital versions of generally accessible legal tender. But people should not confuse it with cryptocurrencies. It's something completely different. All right, and that's it for today. Stay curious. See you soon.